This quarter, I want to step back and give you a longer view of where this cycle stands and where it doesn't. I founded this firm in 1987. We've lent through the downturn of the early 90s, the financial crisis, the correction of 2017, and the pandemic. Every one of those corrections ended in the same way, not with a rebound, with a floor, a long stretch where prices stop falling, activity slowly normalizes, and the market simply becomes functional again. That's what we're watching now. The evidence of a floor is accumulating. In the Toronto area, resale volumes rose for a fifth straight month in July on a seasonally adjusted basis. New listings fell for a third straight month as owners who don't need to sell choose to wait. TREB's benchmark price index posted gains in both June and July's year-over-year decline was the smallest we have seen so far this year. Nationally, CREA reports that prices are no longer falling in most of the markets where they had been doing so. Here's what the data does not say. Resale activity is still running about a quarter below its 10-year average. New home inventory in the GTA sits at roughly 3 years' supply at today's absorption rates, and the sellers on the sidelines are a reservoir of listings. Many will come back as prices firm. That puts a natural ceiling on any near-term appreciation. So our expectation is not a hot market, it's a flat one. Prices leveling off, volumes gradually normalizing, the standoff between buyers and sellers slowly unwinding. For our purposes, that's enough, and I'll come back to why. The more interesting development is inside the new construction market, which is where our lending is concentrated. Sales of new low-rise homes in the GTA have now beaten their 10-year average for 3 consecutive months, in large part a response to the HST rebate. New condominium sales are running roughly 85% below their historical norm. One market is clearing, the other is still finding its price. That split has a consequence that few headlines capture. The construction pipeline is emptying. With condominium pre-sales at multi-decade lows, developers cannot reach the pre-sale thresholds their financing requires. CMHC now projects Ontario housing starts approaching 2-decade lows, with national construction declining through 2028. Projects that don't start in 2026 and 2027 are homes that will not exist in 2029 and 2030. This province's supply problem has not been solved by the correction. It has been deferred and arguably deepened. Meanwhile, at Morrison Financial, underwriting does not change with the cycle, and it is not changing now. We lend against net values at conservative loan-to-value ratios to sponsors with clear path to execution. A flat market is a good environment for that discipline. Collateral values are predictable. Buyer and seller expectations are aligned, and our borrowers' exits, selling completed homes, selling service land to builders, and refinancing depend on how the deal is structured, not on prices going up. We earn interest, not appreciation. A functional market is all that our model requires. Thank you, as always, for your confidence in us.